Choppy straight on the street with Nifty attempting holding above that 26,200 mark and broader indices moving in tandem. FMCG and oil and gas stocks are the biggest drags, even as metal, PSU banks and pharma lend support. More BFSI Q3 updates. Kotak reported healthy sequential loan growth. Axis maintained strong growth on a high base, while bnsn remained an underperformer. L&T Finance saw strong retail disbursement momentum led by gold loans. Trent sulks after standalone revenue growth slows to 17% YOY, the weakest pace since 2021, even as store additions stayed strong and management reaffirmed its 25% growth aspiration. Dabur, meanwhile, flagged early demand recovery post-GST cut, with rural traction improving. JLR's Q3 performance was hit hard by cyber incident and production disruptions, with operations normalizing only by mid-November. Wholesale volumes fell over 43% year-on-year, while retail sales dropped 25%, with weakness across major markets including the US, Europe and China. SBI Funds Management is moving closer to its IPO. Multiple bankers have submitted bids. Sources indicate a potential value of around $12 billion, with draft IPO papers likely to be filed this quarter. SBI and Amundi plan to jointly offload about 10% stake in the issue. Hello and welcome. You have tuned into Buy Now, Sell Now on ET Now. I'm Shruti Sharma and with me is Kavita. And viewers, this is the show where you get answers for all your stock-related queries. And yes, you can connect with us live on the WhatsApp number that will be on your screen and on the top of your screen throughout the show. Tell us your name, the stock that you have invested in or wish to invest afresh. Tell us your buy price as well as the time horizon you wish to stay invested. But viewers, don't forget to mention your name and the location from where you are writing to us. And like always, we will also get some of the callers as well onto the show, patched live on the show to guide you the best way possible. And to guide you today, we have two of our very special guests joining us. We have Kunal Bothra with us, as well as landlord Dikuna, who is the Chief Investment Officer of Value X Wealth Connect, is also with us on the show. A very good morning, gentlemen, and thank you so much for your time. And let's get started then, because a lot of our regular viewers have already started to post their queries. And let me first come to you, Kunal. This query is coming in from Satya Veni from Hyderabad. And yes, he's one of our regular viewers and he needs technical advice on two counters. One of them is Deepak Nitrite, holding the shares at a price of 2,441 rupees. It's been more than 3 to 4 years that he's holding this stock. What to do with this one? And he also has RateGain Technologies, 50 stocks at a price of 844 rupees. He's at a loss on this one. What to do? Good time to average or exit completely?
Good morning. Thank you so much, Srishti. Good morning to all the viewers of now. Now, in the sense of both of these names which you've highlighted, I know which the viewer is asking about, Deepak Nitrite as well as RateGain. I think both of these stocks are completely different. Deepak Nitrite, on one hand, is a underperforming stock. And I think over the last 1 year or so, we've seen the stock correcting by almost 50% from 3,000-ish kind of a high in 2024 towards 1,500 mark, 1,600 range where the stock is trading right now. So it tells you that the stock is an underperforming name. It doesn't show any major signs of a respite, even on the short-term charts. I'll suggest maybe a wait-and-watch approach over here, not to sell, because there could be a possibility that in the next 2-3 months, there could be signs where the bottom could be formed for the stock and you might see some bit of revival. So you need to wait out for that sign to emerge for Deepak Nitrite. RateGain, on the other hand, I think is a stock which is evolving into a breakout mode. The stock is testing the levels of 700, 710 thereabouts. Over the last 2-3 months, there have been 3 major attempts. It's forming a bullish flag formation on the daily charts. So I'll suggest an averaging out for RateGain about the 710 mark once the breakout is confirmed on the daily weekly charts.
All right, so that's the take coming in on both of these counters. But Lancelot, very good morning, first of all. And the query that we have for you is coming in from Ramesh from Bangalore. He has bought shares of IDFC First Bank from a price of 78 rupees. The stock is currently around 85, 86. He's sitting at profits, but good time to book out the profits or continue to hold on.
Well, I think, if you look at, the outlook for the banking sector, the outlook is positive because as interest rates and yields are starting to fall, banks would find credit growth picking up. And we did see some news that in this quarter, credit growth has improved. So given that the stock is trading at, 1.3 times its book value, it's a fairly reasonable price. And you did see some good growth in the last quarter. And I think going forward, we might see an improvement in the credit growth for IDFC First Bank. So it can be accumulated even at this price.
All right, so there's a recommendation for accumulation at this particular price. Let's move on, and we have a live viewer, Dilip from Mumbai. Dilip, hi, morning. Thank you so much for sending us your question.
Good morning.
Hi. Yeah, you can go on.
Yeah. Please.
You have Tata Steel bought at 90, is that right?
Yeah.
Okay.
Yeah.
And your time horizon is how long? 2 years?
2 years, 3 years, no problem.
Any other stock?
Hindustan Copper.
Okay. And you've bought it at?
Hindustan Zinc. Yeah.
Okay.
Yeah. I bought it 305 Hindustan Copper.
305.
Yeah. I have to long time invest. No problem. 2-3 years.
All three counters, right?
Yeah.
Okay, perfect. Lancelot, I'll come to you. Let's start with Tata Steel, bought at 90.
I think, you should continue to hold Tata Steel because over the last couple of quarters, they've been sort of resolving their, European operations. That was the biggest drag on the company. As far as domestic steel operations go, Tata Steel is one of the lowest manufacturers of steel, has been able to expand its capacity for steel production. And you will see almost 3 to 4 million tons additional capacity coming up over the next couple of years. So one should remain invested in Tata Steel because global steel prices are also looking up. As far as the Hindustan Copper is concerned, copper prices are at an all-time high. So at this point in time, it's not a good idea to buy copper stocks, but maybe if you're already invested, remain and stay invested because you will see higher upside when these next 2 quarters play out. We will see the higher prices benefiting the copper companies, so that should benefit. So one can stay invested if you have Hindustan Copper. To buy it may not be the right time because it's trading at a very high valuation. So maybe wait for some decline in the price and then you could add it to the portfolio.
Okay, so he has already bought Hindustan Copper at 305. Yeah, and Hinzinc also he has at 325.
Yeah, so I think both these stocks can be held,
Right.
for the long term because you are yet to see the best prices in terms of copper and zinc and steel. That will play out over the next 12 months and hence you'll get a benefit of the upside. But you must remember that in metal stocks or in commodities, one should always book profits when it is closer to the peaks because they are always cyclical. So at some point in time, you'll see a correction and then, it'll move down. So it's always important to remember to book profits and continue to hold.
All right, that's the take coming in on select metal counters, and even Rakesh Gupta writing to us from New Delhi wanted a view on select metal counters, be it in the Sun Copper and Zinc. So believe that helps answer his query as well. So moving on to the next one, and Kunal, this one is from Bhagwan from Mumbai, has bought 300 shares of CESE, buy price is 173. GSFC 300 shares, 215 is his buy price. The outlook for the next 6 months that he's looking forward to.
So you can hold both of these names. CESC being amongst the power names, we've seen many revival coming back across the power stocks in the last couple of weeks. So that could indicate that maybe CESC could try and come back to your cost price on the higher side. 182, 185 could be a immediate target range, but depends on how bigger the move unfolds for many of the power stocks, and that's where you can keep on trading the stop losses and keep on riding the trend on the higher side. GSFC on the other hand, I think that stock will take some bit of more time because we've seen that the last 1 or 2 months there was a strong move which came for individual fertilizer names, Chambal Fertilizers, Coromandel, etc. But that did not trickle into the names or the likes of GSFC. The stock showed in fact a corrective move from 220 levels to now 180 odd mark where it's trading the last 4 to 5 months. So which means that the stock may take some bit of more time to get back into a revival. I would suggest to just wait out for maybe another couple of months for the stock to come back towards at least 200 to 20 range for a breakout to happen for GSFC.
All right, so that's a recommendation and the strategy coming in on GSFC. But then, Kunal, I have a question specifically for you, and this is from Soumya from Bangalore, and she wants to know the view for 3 to 6 months, REC and Motherson Wiring. She has these three stocks. She's not given us a buy price, but the target time frame is 3 to 6 months.
So REC is a stock which is emerging from a huge bout of underperformance. The only concern with REC is that the stock is prone to a lot of news flows, and specifically around the announcements with respect to government. So I think that's the only concern. Otherwise, the stock price trend looks fairly attractive, fairly positive. We've seen good recovery of 10-15% so far in the last 2-3 weeks for REC. My expectation is that the stock could at least come back towards 400 to 420 kind of a range before it gets impacted yet again with any kind of news flow surrounding the stock. On the other hand, I think Motherson Sumi Wirings, that's a stock which is looking extremely strong. It's perched towards a breakout of a fresh highs. 52-54 is the previous breakout range for Motherson Sumi Wirings. That's a stock which I would suggest to hold on. If you're looking at this as, say, another 6 months to 1 year plus kind of a time horizon, you can expect maybe a potential target range in the range of 60 to 64 for the stock.
All right, that's the take coming in on Motherson Sumi Wiring as well as REC. But the next query that I have is coming in on Tube Investments, and Lancelot OSN Reddy from Hyderabad has been holding the shares 38 in quantity of Tube Investments, but now at a loss of almost 15%. Would you advise for an exit here or add more to average out the pricing? He's a long-term investor though.
So, Tube Investments, even at the current price, after its decline, is trading at almost 78 times earnings. And while the EPS last year was about 34, I think the EPS growth may slow down given the rise in commodity prices. And what you may see is that in anticipation of that, the price has begun to correct. So it may be a good idea, since it's trading at a very high multiple, to exit the stock for now and maybe look at accumulating it when it becomes more reasonable, when valuations turn reasonable.
All right, so it's an exit call on Tube Investments. With that, it's time for a short break, but then post that, we continue our viewer queries session. All you have to do is just send across your stock-specific questions and we will answer them live after this break.
Times its price to book. So I would look at maybe like an IDFC First Bank or other banks could offer better value at this level. As far as Federal Bank is concerned, I think Federal Bank has been doing reasonably well in its outlook. And what we are seeing is its valuation is also at the similar levels. So Federal Bank can be looked at, accumulation, or one can buy Federal Bank even at these price levels.
All right, one can buy Federal Bank even at these price level. That's the call coming in on this counter. But the next query that I have is on Shakti Pumps, and Kunal Radhakrishna wants a view on Shakti Pumps. Can he go ahead and buy afresh for the next 6 months?
See, current levels of 600, with the stock tested, is where the stock has formed a major volume pattern. So just purely when I look at this in terms of the volumes and the contrast in terms of price action over the last 1 year, there is a strong possibility that the stock would probably have formed a major bottom for itself around the 600 mark. But it's still a very high beta stock because when you see a stock correcting by more than 50% in a span of the last 6-12 months, it tells you that the stock is very high beta in nature, could be prone for further corrections, in case if the market gets into that kind of a zone or a phase. So the only tweak which you can do is just control your position size over here to maybe average or slightly lower than average, which you would probably do for a normal portfolio. So that's the only tweak which I would adhere for a stock like Shakti Pump. But yeah, I think in terms of price, current price levels and the recent potential bottom and the jump in volumes, 600 thereabouts is a good support for the stock price. Still trading at 730 levels, which is not too far when you look at this in the context of 2024 highs for Shakti Pump. So I would suggest a buy, but with a limited position size.
All right, it's a buy, 600 important support levels for Shakti Pumps. Kunal, one more short-term question. This is for 3 months. Yes Bank. Balkrishna Hegde from Udupi, Karnataka wants to know. He has almost 9,800 Yes Bank purchase at 19 and sale bought at 130. Targets for 3 months.
So for Yes Bank, I would suggest the next 3-month target in the range of 24, 24 and a half. See, the banking stocks and the bank Nifty is doing fairly well for itself. And if this trend continues, maybe Yes Bank can come back towards the high which it had hit in the month of October. So that's a stock which I would suggest to maybe keep that as a target range. The second stock which you mentioned was?
Sale.
Sale. So I think it's been a fantastic uptrend for Sale and the metal pack in the last 2-3 months. But I think closer to 150 mark is a good zone where I would suggest to average or maybe book out profits over here for Sale and then look to buy back in case if the stock tips down to 137 to 140 range.
All right, that's the take coming in on both of these counters. But let me move on. And the next query that I have is coming in on KNR Constructions. And what's your advice, Lancelot, over here? Because Samit from Noida, I think he's writing to us for the first time, wants an advice on KNR Constructions. He has bought 350 shares. His buy price is 323 rupees. Lancelot, any view here? Of late, we get to see that KNR Construction keeps with the news flow and keeps being in the news on the back of new order wins.
So, KNR Construction is a very small market cap, about 4,300 crores. And if you look at it, it's trading at 6p. But, with small, while it is in the EPC service provision provider across highways, flyovers, etc., it's a relatively small cap company with, very little profit growth. If you look at the profit margins, they are very, very low and its net profit margin is low. So it's better to avoid, investment in small cap companies where, profit growth is slow and profit margins are low.
Indeed, it's best to avoid companies like KNR Construction. That's the advice coming in from Lancelot. But Samit has already bought the shares, Kunal. He's already bought at a price of over 300 rupees, and investors feel stuck at some of these counters. Whenever a person gets stuck like this, what should be the advice, and particularly for KNR Constructions? Any view here?
See, the only thing which you can do is find out those points where you may just want to average the stock price and try and trade this maybe a couple of times. For example, you've already eroded 50% of your capital if your average price was around 300 and the stock is, say, somewhere around the 150 mark. Recently, also, the stock went down to 140, 42 levels thereabout, if I'm not wrong. But then in a matter of, I think, maybe 1 week, 10 days, the stock price jumped back towards 180, 185 mark. So that's almost like a 20-25% jump in the stock price in a very short span of time. You'll have to try and use those events, use those zones where the stock price is moving up by 20-25%. So even if you have 2 such trades, you can at least try and narrow down your losses significantly. That's the only way you can probably try and cut down your losses, and then it makes a lot of sense once you cut down your losses to a reasonable extent. It then makes sense to try and switch back towards formidable stocks or the ones which are performing. The only concern with stocks like, I'm not saying KNR Construction as such, but stocks which fall by more than 50% is that time which you'll have to hold on to those stocks for these stocks to come back to your cost price. In that time zone, you would probably have missed maybe another 2-3 major stocks or sectors which would probably have yielded you far better returns. So it's the time element which is very, very important in the domain of equity markets, and especially with respect to stock specific. So that's why we always advise that you have a certain sort of a stop loss inbuilt when you buy the stock prices, even if it's down 10-15%, the moment it's down, you try and find some other name, some other performing sector, and try and invest over there.
All right, very important to know your risk factors. But then having said that, it's time for a short break on Buy Now, Sell Now, and post that, we'll continue answering your stock-specific questions.
Seeing the bottom or growth rate for Trent, and better base effect, better performance by the company from here on out should help improve its growth prospects going ahead.
Okay, and Jignanshu, I'm just trying to throw some numbers over here. In July of last year, at their AGM, Trent had said that they're aiming for a 25% top line growth. Given the way the 3 quarters of FY26 have already panned out, it means if you put these numbers together, they've done about 14,700 crores of revenue so far in the 3 quarters, which means if they want to log in this 25% growth, they need to do a minimum of 7,300 crores in the next quarter, in quarter 4. How likely or unlikely do you think that is going to be, and do you think they're going to be able to meet this 25% guidance?
No, I think it's quite unlikely. I think it's pretty obvious from the numbers, like as you rightly mentioned, that 25% growth guidance for this year is quite unlikely. Even for them to achieve a 20% growth guidance, which is sort of the lower range of their medium to long-term guidance that they've been talking about, it will take some feat for them to do that in this year, right? It needs almost 30% growth in the last quarter, which is going to be very difficult as well. So, yeah, I think it's about resetting expectations that investors have had, that this is not a 25% growth company. At best, we like to think it of as a 20% growth CAGR company over a 3-year time period.
Jignanshu, on the back of that, since you also agree that this is going to be very difficult a feat for Trent to achieve, is there going to be any change in the way you are viewing the stock, your target price? Because you still continue to maintain and outperform with a target price of 5,000 rupees. That's your stance. So any change expected over there?
No, so I think we revised our numbers on Trent last quarter, and we sort of as of now we stand by those numbers that they should be able to do a 20% growth rate over the next 3 years, with another 100-200 bips of profit growth additional on top of that revenue growth, largely driven by operating leverage improvement. So that gives us our target price of around 5,000 for March 27, which we think that they can still meet. We think that while both the price pickup in run up to the quarterly results and the reaction today are both sort of overdone, and we expect that gradually as the overall sort of consumption stabilizes, but more importantly, Trend's growth improves given base effect, given their own initiatives that they've taken at the stores to let go of inventory, to add more stores, and so on. We do expect them to go back to a 20% growth number next year.
Okay, so while that sounds optimistic, Jignanshu, talk to us about what happens to the margins, because given the erosion in top line, despite that, the margins have continued to do very well for Trent. Even in the previous quarter, the margin figure was around 17.2%. What is your outlook on what happens to margins this quarter, given that the revenue growth is also expected at 17%, which was the similar figure we saw in quarter 2 as well?
Yeah. No, see, we think the margins have peaked in quarter 2, at least in the short term. So Q3, Q4, we expect the margins to be similar or slightly lower than what we saw in Q2. Their quarterly margins are heavily impacted by how the rental agreements are structured, which have a sliding scale mechanism, because of which their impact on the cost structure as percentage of revenue sort of falls throughout the year, right? It's very high in Q1 and it's low in Q4. Where I think they've really made the change in cost structure is in the employee cost, where they've been able to reduce the number of employees that they need at every store to service the number of footfalls that they get, with the advantage of technology, right? Both at the store level and at the back end level. And hence, we think that a margin structure which is current, which is around on a pre-Ind AS basis, which is after rent, around 12% is something which is sustainable.
Okay. And Jignanshu, do you believe there is more room for further EPS downgrade on the stock? Is that something that you're viewing right now?
Yeah, I think on the sell side, we do expect some downgrades to come on the revenue growth, but and with associated some EPS downgrades on the downgrades for 27 and 28 as well. Yes, I would
Okay.
expect that to happen. We don't have plans for it. We retain our target price as of now, but from broad-based street perspective, the miss should trigger some of that
Okay,
potentially.
so Jignanshu, on the back of that, you did say earlier that the street is somewhere largely trying to digest the fact that this is not a company that grows at a 20 to 25%. It's going to, and it is reported slightly below that. At what point do you think the market is going to fully price this in? Because every time a trend update has come up in the recent past, the stock has seen a beating like the one it's seeing today. So by when do you think this is going to start getting factored in, or when do you see the tides changing?
I thought that by mid-December, we felt that it was at its bottom, right? That the worst case scenario of the stock, where a bottom would not be 17%, but a bottom would be around 15% revenue growth, was priced in. However, the run up to this, I would say the price action today is primarily a reversal of that run up that we saw from around mid-December to early Jan. So it's not negative. And that's why I would uh, differentiate this price reaction today with what you rightly mentioned as the price reaction for the previous few quarters.
Okay. And
That
lastly,
this is more a
Jignanshu,
scale back
yes.
of the run up rather than negative reaction. Yeah.
Okay, okay, understood. And lastly, Jignanshu, before we let you go, also throw some light on the store edition pace that we've seen for both Westside and Zudio. And now that there are categories like burnt toast that are also picking up some steam, do you believe Zudio stands at a risk of cannibalization at all, or competition from internal brands itself?
See, I think the management is pretty astute in creating different brands for different consumer profiles. So I think the brand for the consumer TG for burnt toast is fundamentally different from that of Zudio, which again is different from that of Westside. So I would not be too concerned about cannibalization between those three brands. The challenge for the management is to find the next credible large growth vector besides Zudio and Westside. Right, Bantos is too new, so is Zudio Beauty too small. Their lab grown diamond is also too small, not enough commitment in our view. Star Bazaar is a bit ambiguous, what their approach and aggression there is. So I think for the management to go back to even to attempt a 25% growth trajectory, which you mentioned earlier, they need to be able to find a third large sustainable growth lever, which we believe is missing today.
Okay, and Jignanshu, let's talk about the price to earnings. The valuation at which Trent trades right now, close to 90. Do you believe this valuation is fair? Do you believe this multiple stands to be re-rated?
So we think that we value Trent on 27 or 28 multiple rather than immediate multiple. So in our view, we do it at around 55 to 60 earnings of 28 EPS. Right, so that's where our valuation of 5,000 rupees comes from. That our EPS for FY28 is 83 rupees, and our EPS for FY27 is 70 rupees. So it's 70 times 27 EPS and around 55 times 28 EPS. And we believe at that range, at 55 times 28 EPS, it is less than 3 peg, so 2.5 to 2.7 odd peg, which we think is an appropriate multiple for a fast fashion brand, which is stable, largest in the country, and has a credible track record of reviving its brands.
So just to sum it up, Jignanshu, do you believe the worst is in the past for Trent? Because you did say that a positive base effect will now start kicking in, given how lackluster this financial year has been. So that's FY26. Now, do you believe the worst is behind Trent?
Yes, both base effect plus their own steps, their strategic steps of cannibalizing their stores, of couple of cycles where weather, etc., sort of was not supportive, geopolitics was not supportive from supply chain perspective. All of those should sort of help have a good effect as we move from Q4 onwards.
Okay, Jignanshu, really appreciate you taking out your time to speak with us and accommodating our request. Thanks once again. It's been great chatting with you.
Yeah, all right. Thank you.
Thanks so
Cheers.
much.
Bye-bye.
Okay, viewers, on that note, time to slip into a very short break. On the other side, Buy Now, Sell Now will resume with your queries, so stay tuned.
25 and 35%. Mr. Mondal, first off, the rally in the stock price has been extremely sharp. I wish to congratulate you that investors are rewarding you for the kind of performance that you are putting up. But talk to us. 2,500 crore is your growth in AUM, absolute terms, give or take a few crore. And the entirety of that 2,500 crore is coming from gold loans. Is this a very large risk? If gold were to come off substantially, does your growth get impacted?
Good morning, Ash, and
Good morning,
Happy New Year to you and your viewers.
Wishing you a very happy 2026, sir.
Thank you. From a growth perspective, let me put it there. I mean, you talked about the market and stocks. Our job is to only execute and do our job and let market do whatever they want to. But from a growth perspective, I think we have grown two businesses pretty well this quarter. One is the wholesale part of the business, and one is gold part of the business. Because if you look at it, gold is 46%, which is roughly 50% of our portfolio. Then other portfolio would have also grown equally well. Now, coming to the risk factor which you're talking about, yes, gold prices has been reasonably elevated for the last fairly many quarters. And but the good part is that we have taken risk mitigation in terms of what we need to do, and our LTV overall is somewhere around 60% or below at this point of time. And we also do our risk analysis in terms of sensitivity analysis of if there's a 5% drop or 10 or 15, 20% drop, and see where we are. Also, what happens is this LTV includes the interest rates in that, the interest gets added. So to that extent, that kind of a huge margin is there. And these are all short-term book. These are like 6 months, 1 year kind of a book. So from a risk perspective, we are pretty well covered. But yes, I mean, we have to build up the other businesses. The wholesale business is picking up pretty well. We have put our entire core system migration and other systems in place. So now retail will also start picking up. And of course, the most important thing is how do you build the deposit franchise? And that's the game which is going to be playing out in the next 2 to 3 years. And that's what will build the bank for future.
Right, Mr. Mondal. I'm trying to figure out what the downside risks to this growth could be, because such a fast pace of growth. Now, your loan to deposit ratio, if I'm just trying to pull that out, it's around 90%. Is that a concern? And is deposit book accretion proving to be a challenge?
Harsh, the deposit book accretion is a challenge from the entire ecosystem because you know what's happening in the macro, right? And all the banks are going through a little bit of a challenge on the deposit accretion. The systemic deposit growth is much slower than the asset growth for the last few quarters. And hence, to that extent, not only us, we are a small bank, even medium and large sector banks are also going through the similar challenge. So there is no uniqueness to that to us. Having said that, on your question on the CD ratio, Yes, we are a little higher than 90%. Our comfort zone is between 85 to 90. But the reason we are still quite comfortable is because there has been a large borrowing book, FCY borrowing we had taken from IFC and HSBC and some of the other banks. So that gives us that cushion. We are also sitting on fair bit excess SLR. So to that extent, from a liquidity perspective, our LCR is quite comfortable. So that way, from that perspective, it's not an issue. But yes, going ahead, every quarter, every bank has to focus on deposits, and so will we. We will also have to do the same thing.
Absolutely. Mr. Mondal, therefore, can I, with great comfort from an investor lens, say that LDR will not impact your loan growth?
No, it will not. Okay. LDR will not impact our loan growth. And we, of course, will not take any liquidity risks, because when you're growing by 29% this quarter, last quarter also we grew by similar kind of a number, but our guidance is between 25% and above. So to that extent, we have fair bit of margin between what we are kind of guiding the markets or straits and vis-a-vis where we are today. So we don't have that challenge at all.
Okay. Mr. Mondal, my sincere apologies. I'm going to have to pause you here. I have to take a committed break, but I'm going to come back straight back to you, ask you a couple of more questions, and then let you go. Sure. Thank you so much for staying put. And viewers, thank you. This conversation will continue.
This is worth sharing. Faster Wi-Fi on the new Emirates A350.
माही भाई, कोई कूल बैंक बताओ ना जो कस्टमर के साथ हर कंडीशन में हो।
फिर तो SBI कूलेस्ट है।
हाँ?